I'm Sean Cooper, president and owner of Fit Financial Consulting, LLC, a registered investment advisor. Today we're talking about taxes, what most people consider to be a necessary evil. I don't necessarily agree that they are necessary at least not at our current tax brackets, but I would say they're probably here to stay. If we look at taxes from a historical standpoint, we're actually at a relative low, even though I would argue that they're excessively high. If you go back to 1944, the highest income tax bracket was actually 94%. Doesn't provide much of an incentive to work, in my opinion. However, if you go back further, but prior to 1862, again between 1873 and 1893, and finally between 1895 and 1912, there were no federal income tax brackets, which is why I could make the argument that they're not necessary per se. With that said, I still think they're here to stay. I don't see the people in Washington cutting their budgets to reduce our tax burden, and certainly not taking pay cuts in order to do so. So where does that leave us? Well, this is a breakdown of our current tax brackets. As you can see, this is going to be the tax rate for each level. This is for a single filer, married filing jointly, and head of household. This is the increase from 2018. As you can see, this increase is pretty modest. So this is measuring the tax bracket, the dollar amount increase. And then this is the increase for the standard deduction from 2018. Again, these numbers are incredibly low, 2% or even slightly less. And we actually want these to be high. This is thanks to our new tax regime tying the increases in the brackets to a slower CPI. That's the Consumer Price Index. And what that means is really they're just assuming a lower inflation rate year after year than what was the prior CPI was tied to. And this is not good for us. We actually want these numbers here to go up more quickly to help keep us in a lower tax bracket over time as we receive raises or promotions and things of that nature. So with that said, how does this table really work? Now, if we take an example, first off, this is a tiered system. And to give you an idea of what that means, take an example of an individual filer making $100,000. If this was a linear system, that $100,000 would put that person at the 24% income tax bracket. So we would assume they're going to have to pay $24,000 in taxes. Now, fortunately, this is a tiered system, and we have deductions. So first, the standard deduction is $12,200. So we're going to take the $100,000 and subtract the $12,200. Or if your itemized deductions are higher, we can actually reduce that from the $100,000. But for argument's sake, we'll assume it's just the standard deduction, which brings the person's taxable income down to $87,800. Now, of that $87,800, the first $9,700 is going to be taxed at 10%, or $970. The next $29,775, which is $39,475 minus $9,700, is going to be taxed at 12%, or $3,573. The next $44,725, $84,200 minus $39,475, is going to be taxed at 22%, which is $9,839.50. And the final $3,600, which is the $87,800 minus $84,200, is going to be taxed at 24%, or $846, for a total tax bill of $15,246.50. Now, this is exorbitant in my opinion, but still significantly lower than our initial assumption of $24,000. And this gives you a gist of how this whole system works. However, it does not account for Social Security, Medicare, unemployment tax, which is paid by your employer or by you if you're the employer, and state or local taxes, income taxes specifically. So, jumping into those, first off, you have Social Security tax, which is 12.4% on income up to $132,900. And this is a 3.5% increase on that cap from last year. So as you can see, they're still increasing that one more rapidly so that they can continue to get their taxes. However, you're probably not going to recognize that entire burden because your employer is actually going to pay half of it for you, unless, of course, you are the employer or self-employed. So you only pay 6.2 unless you're self-employed, in which case you get the full 12.4% burden. The same holds true for Medicare. It's 2.9%, but your employer is going to pay half, leaving you with 1.45. Now, the difference with Medicare is there is no upper income limit for that tax. So however much you earn, you're going to get charged that 1.45 or the 2.9 on all of it. Next would be unemployment tax, which is just for your employer, or if you're you are the employer, and it's 6%. The federal government does provide a tax credit of up to 5.4% if you've already paid state unemployment, but regardless, you're essentially still going to be paying that no matter how you square it. And last would be state income tax, which ranges from 0% in a few states, thank you, or up to 13.3% if you're in California. As you can see, once you add up all of these different pieces of the pie, that they stack up very, very quickly. So how do you reduce this burden? The most common way, especially given our new tax regime, is just with the standard deduction that we talked about earlier, which is $12,200 for individual filers and $24,400 for joint filers. For some people, if you're a higher income earner, you may still be able to get a bigger tax deduction by itemizing. However, a lot of those itemized deductions have become less favorable than they were in the past. So a few common examples of that. One would be if you are a business owner. Your biggest tax deduction as a business owner is going to be your business expenses. Now, it's pretty straightforward on the surface, but it gets infinitely more complex once you start throwing in different methods of depreciation and what you can depreciate, what you can't depreciate, and things of that nature. So I definitely recommend reaching out to a tax professional for that advice. As you're screening them, lean towards a CPA or EA, and if you can find someone that actually worked for the IRS in the past, that's also a bonus. The second big tax deduction for anyone is going to be contributions to your retirement accounts or to HSAs, which are health savings accounts. And I talk about the retirement accounts in length in my retirement video that I posted a few weeks back, so be sure to check that out. Another is going to be interest on your primary residence. So any interest you pay on a loan for your primary residence, and that's a loan up to $750,000 for joint filers or $375,000 for individual filers. And that represents a $250,000 decrease for joint filers and a $125,000 decrease for individual filers. So like I said, not nearly as beneficial as it was in the past. Another would be your child tax credit. So you can take up to a $2,000 tax credit for each child, provided your adjusted gross income is below $440,000 for joint filers or $240,000 for individual filers. And keep in mind, that's a credit, not a deduction. Credits are actually better than deductions because it reduces your tax burden dollar for dollar, whereas deductions reduce your taxable income. Other examples would be installing energy efficient appliances or solar arrays and things of that nature. Each of these things, it changes year over year. There's a plethora of different things that you can potentially do. So definitely talk to your tax professional about that. And I will conclude with capital losses. Most people think only in terms of capital gains, but it is a double-edged sword. Capital losses have a certain advantage. They can actually be used to offset your capital gains. Long-term capital losses offset long-term capital gains. Short-term capital losses offset short-term capital gains. And they're taxed very differently. So your long-term capital gains or losses are taxed at 15% for most of us. Anyone in the top 4 income tax brackets is going to get hit with an additional 3.8%. Or if you're in the top 2 income tax brackets, you're going to actually be hit at 20% plus the 3.8%. So they like to tack on that extra for the higher income earners. For short-term capital gains and losses, you're actually taxed at your income tax bracket. So as you can see, typically long-term capital gains and losses, as well as dividends, which are also taxed at the 15% level, are much more favorable than short-term. So how is this useful? It's useful in a couple of ways. First, in regards to asset location. So if you have multiple investment accounts, you can choose to invest your less tax favorable assets like bonds, alternative investments, and high turnover mutual funds in your tax favorable accounts, your retirement accounts. On the flip side, your more tax favorable investments like your individual stocks held for the long term and low turnover ETFs, exchange traded funds, can be in your non-qualified account, your individual and your joint investment accounts, because they're not going to generate as much of a tax burden. The other way that this information can be very useful is in regards to tax harvesting. So I said that capital losses can be used to offset capital gains, but you have to recognize those losses, which means actually selling the asset to recognize the loss to offset the gain that recognized a gain. I have mixed feelings about this last strategy because it implies that you are buying high and selling low, which is the exact opposite of what we want to do in investing. We want to buy low and sell high, but you have to recognize that loss to use it to offset the gain. It can still make sense if the loss is sufficient to offset the gain and the tax bill reduction is sufficient to justify it. Also, if you have other investment options that make even more sense at this point in time, then that strategy is even more beneficial because you're getting out of an investment that you don't think is going to provide gains in the future and getting into one that you do think will provide better rates of return. Another debate that really comes up when it comes to these accounts is between traditional IRAs or 401ks and Roth IRAs or 401ks. For traditional IRAs and traditional 401ks, you get a tax deduction in the year you make those contributions. It effectively reduces your taxable income in that year. Those assets also grow tax deferred, which can be very advantageous. However, once you retire, all of the money that you pull out of those accounts is going to be taxable at your income tax bracket. Roth IRAs and Roth 401ks are almost the exact opposite. You get no tax benefit in the year that you make the contribution. It does grow tax deferred, but the real kicker is when you pull money out of those accounts in retirement, so after age 59 and a half, it is all tax free. And that's the biggest advantage. What makes the difference? Honestly, you're probably going to have to do the individual calculations for yourself or have your investment advisor or financial advisors do the calculations for you. But in general terms, the younger you are and the lower your income, the more likely a Roth version is going to make sense. The closer to retirement you are or the higher your income, the more likely one of the traditional IRAs or 401ks is going to be the most advantageous for you. The other thing to consider is where you think taxes are going. If you think taxes are going up by the time you retire, then a Roth IRA probably, or a Roth 401k probably makes more sense. If you think they're going to be lower when you retire, then stick to the traditional IRA or 401k. The other factor is where you think your personal income tax bracket is going to be. A lot of professionals suggest that you're going to be in a lower tax bracket when you retire because you don't need as much income, you're not generating as much income, and you don't have to pay for your house or your kids and things of that nature. I tend to disagree with that assessment for 2 reasons. First off, I recommend replacing 100% of your pre-retirement income in retirement. Second, you're going to lose a number of tax deductions once you reach retirement, like the interest on your house, potentially, assuming you've already paid it off, and the child tax credit, assuming you've got them out of the house at that point. Again, all this stuff is covered in more detail in my retirement video, so check that out. And lastly, I've mentioned this earlier in the video, and that's the HSA, that's the Health Savings Account. If you have a high deductible health insurance plan at work, that's an HDHP at work, then you may be able to invest in an HSA. And this can be one of the most tax favorable investment accounts that you can put money into across the board. As an individual, you can, as a family, you can put up to $6,900 into an HSA. As an individual, you can put $3,450 for 2019. The beauty of an HSA is money that you put into it is tax deductible in the year you make the contribution, meaning it reduces your taxable income that year. It grows tax deferred, and provided you use that money for qualifying healthcare expenses, it is tax-free when you withdraw it. The drawback is you have to use that money for qualifying healthcare expenses. If you don't, it's going to be taxable at your income tax bracket, and if you're under age 65, you're going to be hit with an additional 20% tax penalty. So very hefty tax penalties if you use it for anything other than qualifying healthcare expenses. But it can still be one of the most tax favorable investment options, provided you use it correctly. I know this has been a very lengthy video. To be honest with you, I've still only scratched the surface of this country's lengthy tax code, so definitely reach out to your CPA or EA for more tailored tax advice. And if you want to, you can also check out the IRS's website. That's www.irs.gov. I've actually found it to be very user-friendly, surprisingly user-friendly and navigatable, and it's always great to get information direct from the source. As usual, feel free to reach out to me as well. My number is 720-808-6979, and my email sean.cooper@fitfinancialconsulting.com. Thanks.